Started and okay, so the question just came up, and it is, what are some companies or some suggestions for the project two companies that you may want to look at? Um, I would say, generally speaking, keep it a smaller company that's focused. It doesn't absolutely have to be a small company. There are big companies that have a um, very focused operation. I think I threw out Costco, for example. Costco is Costco. They do one thing. They're a huge retailer, right? Okay. It would not be difficult, I don't think, to analyze Costco, or no more difficult than other companies. Okay. But there's smaller companies that do, you know, very focused things. I can throw out some WD-40. Geez, guess what WD-40 makes? Okay, now they do have two segments because they have retail and industrial. Okay, not a huge deal though, right? Um, you get some consumer product ones, Colgate Palmolive, or Procter and Gamble. They make a lot of different products, but basically they're making products and then selling them to retailers. Okay, so you know throw out a company, take a look at it, put it in the thing. I'll take a glance at it. I'll quickly look at what I think about the company, and I'll let you know. Okay, so this can be a little bit of give and take. That's why I want you to get going on it. But I think most importantly for you guys, pick a company you got a little interest in. Say there's a lot of diesel students that end up taking this class because it's part of the equipment management degree, and a lot of them will pick a Cummins, or they'll pick a Caterpillar, or they'll pick John Deere. Okay, and I get some farmers that pick John Deere too, and John Deere's a big company. Okay, and they've got both an industrial side and a kind of farm and ranch side. The equipment that they make, but by and large, they make equipment. Okay, so it's not totally out of line to use a company like that, to choose a company like that, in order to analyze. Did that answer your question, Marty? Okay, yeah. Most importantly, just get something in there that you got an interest in, and then we'll take a look at it. I'll take a look at it, and we can discuss it. Oftentimes I've had some folks throw out some companies that I kind of go, I'll ultimately leave it up to you, but I might give you my little thoughts about, that may be a little bit difficult, to analyze, right? Okay. And again, I kind of dissuade people a little bit from finance types of. Here we are in a finance class, but financial companies like banks and whatnot. Okay, in finance class, we're analyzing typically other companies that have a more traditional balance sheet and income statement. When you get into banks and whatnot, their balance sheets and their financial or their income statements and whatnot, they just look a little different. Okay, if we could spend another semester, we could go through and talk about the differences and whatnot. But for our purposes, let's just try to limit it to kind of non-financial companies. Insurance companies fit in that same thing. The way they make money is just a little bit different. I mean, they've got flow, and they've got some things out there that we don't just have a chance to talk about in this class. And so I'll urge you to stay away from those types of companies. Okay, so this week, we are week 6 already. So we're almost halfway there, and so your project one's going to be due here pretty quick, right? Okay, so the finishing touches on your project one are going to be due here pretty quick. Last week I talked about the sales forecast and additional inputs, right? And I think I don't have that due until Thursday or something. I'm not sure. Yeah, okay. And so next week then, the final touches will be on this, and that's going to be the cash flow and the balance sheet. And so let's talk about the cash flow and the balance sheet. Let me get, went over the sales forecast, yep. Yep. Okay, there we go. Let me open this up, and then we'll. Okay. So when we get to the cash flow, please note on the cash flow, there's only what, 4 rows that you can have any input for. Okay, only 4 rows that you can do. And I'm going to tell you that dividends is not one of those. So now we're down to 3 rows, and only 3 that you can have any that you can have any input, right? Okay. For most of you, additional inventory is not going to be a concern. Okay. The program kind of automatically determines what your inventory restocking needs are, if that makes sense. Okay, so yeah, we've always got to replace our inventory, but the program just kind of assumes that we're going to have a constant level of inventory, right? What we sell and et cetera, et cetera. This would only be if you know you're really fastly growing, okay, and you thought you needed to have an increased inventory stock. If you thought in year 2 or 3 that you were going to grow your company or add another product line or do something like that, only then would you have additional inventory. So for most of you, this is not going to be the case. You're not going to need any additional inventory, okay? And for most of you, probably will not, okay? So now we're down to a couple lines, right? Owner's distribution. Everybody will have owner's distribution, okay? This is one of the common things I send back to people and say, you got to fix this, okay? So this is where you pay yourself. Remember, we go back to the payroll, and I said, you do not get paid under payroll, okay, because you are not a C corporation, because you probably would not be a C corporation. So this is where you pay yourself, and an owner's distribution, okay. What you need to kind of watch is, you know, make sure that if you're paying yourself, you're not paying yourself with a lot of borrowed money. We're not going to be like the government and run huge deficits. So you'll look at your cash flow before you start doing that, and you'll kind of see if you've got some net positive cash flows. If you have net negative cash flows, then you got to go back and do some rejiggering, right, on your sales or your expenses, right? You got sales, which is income, you got expenses, and payroll, which is outgo. If you got too much outgo, you got a problem, and you got to go back and fix that, okay? So that's another big issue that I oftentimes will send things back and say, you got to fix this because you're running a huge deficit and you can't do that. So you kind of get an idea of, you know, what your cash flow is, and then an idea of what you can pay yourself. You know, and it could sure start at, you know, maybe you got to start slow at $1,000 a month or something like that. And by the end of the year, hopefully you can get up and pay yourself something reasonable. We used to get, you know, when I used to send in SBA types of loan applications and whatnot, they'd get sent back often if it was too low. The SBA would say, this person can't live on that amount of money, and so that makes it an impractical loan application or an impractical plan. Oftentimes we could offset that if the spouse worked someplace else. We could say, oh, wait, you know, husband or wife's a lawyer, it's fine, they don't really need the income, so no big deal, and we get past it. But if this is what you're looking to live off of, you know, you got to have a reasonable amount in there, okay? So that's year 1. Years 2 and 3 are the same thing, and again, oftentimes I send these back because people don't put in owner's distributions for years 2 and 3. And for years 2 and 3, you got to do it all the way through, right? Okay? Is it okay to pay yourself $2,000 a month and just, you know, drag it out? Sure, that's fine. Okay, whatever the case may be. The line of credit is the only other one on here that you may have some input into. Some of you, again, may have additional inventory, that's fine. But the line of credit repayment, and this will happen sometimes. It'll happen sometimes at the start of a business, right? You'll run a little deficit, okay? Farmers and ranchers deal with this all the time. We've talked about that a little bit, where during the summer they're running a deficit because they got a seed, they got spray, you know, fuel, they got all those expenses, and then they pay that back in the fall. You know, ranchers similar, okay? And so they run a deficit in here, and then they have income that comes in here. And so this can also happen very much if you're a seasonal business. You may end up having a line of credit balance that shows up down here. Hopefully then later you'll have the income that'll offset that. And so this is where you just have to kind of watch it. And if you're getting a line of credit balance, now if the line of credit balance is big and just keeps getting bigger, then you've got a problem. If it, gets to 5,000 and it stays at 5,000, that probably means that you're starting to accumulate some positive cash. And if you're starting to accumulate some positive cash, then you need to pay off that line of credit. Okay? And you would do that here with the line of credit repayments. So what happens here, let's say I've got a $5,000 line of credit balance. I'm not going to enter anything in the white space because that'll goof things up. But let's say here in whatever month 4, I got a $5,000 line of credit balance. I'm not showing any cash flow, but it kind of tops out there, and in month 8 or whatever, I get over here and it shows that I have operating cash balance of $8,000. Okay, well, I could completely pay off that line of credit then, and then I would come up here and I'd put 5,000, whatever the amount is for that line of credit. I'd just put 5,000 in there, and that would pay it off. Okay. If I only had a $4,000 operating balance, I may pay down my line of credit $1,000. Maybe next month I could pay it down $1,000 again. So you could do it over multiple months as well. And remember, the line of credit costs you interest, so it's in your interest to pay it down, as quick as possible. So, Marty, question? A loan that you have on your starting point is different. Okay. Yeah, this is a fully amortized loan here. Okay, it's a term loan, we'd call that. Okay, you're just making monthly payments on that. And the program takes care of that for you. That's going to show up on your income statement and interest payment. It's going to show up on your cash flow in both. Line of credit is like if you were a farmer or rancher, okay? And so you go into debt during the summer because you don't have any income. You pay it back off in the fall, okay? But that can happen in other businesses as well. Some of you may have that just in your startup. The first couple months, if you're projecting, that your sales are starting slow, which is reasonable, and you're going to grow those, you may have a line of credit balance where the bank, somebody's going to have to forward you some money on a line of credit that you'll then pay off when business picks up, okay? Not unusual at all, okay? Some of you may have some big cash expenditures at one point in the year. I don't think anybody in here has a business that's like that necessarily, but that's possible. Again, that'd be more like a farm and ranch type of a thing, right? Okay, so you got a bunch of seed, you got a bunch of things like that. Okay, so make sure that when you do your cash flow that you look at years 2 and 3 and all the way through years 3. Again, there's really only a couple rows that you have to look at, so even though there's 3 years out, it's not too big, to take a look at. Make sure it looks okay. Holler at me. I'd love to come around and look at it and okay it, because then that sure makes my correcting of it a whole lot easier, right? Now, if you notice when you get to the income statement, there's not a single orange or yellow or whatever color, gold, whatever color space, okay? And that goes for years 2 and 3 as well. You don't have to do anything on the income statement. It's going to fill that all in for you. Okay? So that's nice. The balance sheet is all white as well, but, okay, do this for me. If you hopefully you have this opened up right now, okay? And when you get to the second year of prepaid expenses, and you can see that there's a formula that's up here, okay? When I asked you to change the amortization to 1 year instead of 3 years, okay, it goofs up years 2 and 3 here. Don't touch year 1, but in the second year, you could come up here and hit delete. I gotta go up and change my deal, right? I gotta unprotect it. 1, 2, 3, 4. Okay. I can delete that formula, and I can also in year 3. Yep. Okay. Otherwise, you will not balance in years 2 and 3. Leave it there for year 1, but delete years 2 and 3. Okay, otherwise you won't balance. Okay, so row 12, prepaid expenses, second year and third year, just go in and delete that. And you could wait until you get all your numbers put in and you're gonna have a number there, and you could go in and delete the number as well. Because if you don't, that's how much you're gonna be out of balance. Okay? Sometimes there's other initial costs that might end up in there too. Um, We'll have to take a look at that and see if you get that show up. Okay? Then other than that, your balance sheet should, again, it's gonna fill in all on its own. So that's the only thing you should have to do to the balance sheet in order to get balanced, and you'll be in good shape. Okay? Whatever you do, don't force balance this. I get those sent to me sometimes because, it doesn't balance and folks get upset, so they come down here and they change one or two of these numbers. I guess I won't guarantee you that I've caught that every time, but I generally do. Okay? I can generally glance at the balance sheet and see myself whether it ought to balance or not. So don't force balance it, please. That just makes my work a little bit more difficult. If you don't balance, put your hand up in the air and I'll come around and we'll figure it out. Okay? It's generally going to be, it's just about always going to be because of this prepaid expenses. Okay? And that's because I had you change that amortization period from 3 years to 1 year. Okay? Any other questions about that? You get that done, and guess what? Project 1 is going to be complete. So then we can wrap it up and get going on Project 2. Marty? Yeah? Probably not. Okay? Do you have that as an inventory? So you've got an initial inventory. Yeah. You'd only do that, and that's fine if you're growing. If you think I want to grow my inventory because my business is growing. Yep. Then that's fine. Okay? Yeah, you may. If you're going to keep growing like that, yeah. Yep, that's fine. That's not a bad example of something that says, yeah, I got to grow my business, and so I am going to need a higher level of inventory, and so then I'm going to have some additional inventory. Okay. Typically, if you're that coffee shop, your inventory is going to stay fairly static, right? Any other questions? Okay, I'm going to quit then and let you guys